Why do people take out whole life insurance policies, specifically focusing on the cash value? What are the core benefits? What interests them? Well, when we look at the cash value, there are really three core benefits that attract people to cash value life insurance. If you're looking for the reason why would you put money into this product, and someone asked you, hey, why do you have whole life insurance? Like, what's the benefit? I've heard horrible things about it. Here's the core benefits. It is a safe, liquid, tax-free area to position money. Now, if you were to tell me that, and I'm new to whole life insurance, or anything for that matter, my follow-up question would be, okay, that sounds great, but can you tell me more? Because that sounds a little bit like a sales pitch. Give me more details so I can really understand how this works. So core benefits are as follows. We've got a safe, liquid, tax-free area to position money, and we're going to go into more detail on this today. We're going to spend a lot of time on the safety feature. So as we look at the core benefits here, if I can fit it all on the screen, there we go. I like to have fun with this board. Safe, IRR of 3 to 5%. What IRR represents is internal rate of return. If a policy is designed properly, we touched on this during our last video as far as the premium and PUA component. How do I minimize that premium? Get as much money into the PUA rider like what corporations do. That's how I beef up the cash values. And if I use one of the top companies that have a track record of delivering the strongest cash values on whole life insurance products, the net internal rate of return will likely fall somewhere between 3 to 5%. Now, when we hear that, is that attractive to us? Or do we hear that and think, 3 to 5%, like maybe it's better than a bank account, but I've got other assets that are doing much better. This is often what we hear. We're going to touch on that more in the objections video. But when we get to that, that is. What I will also mention about this, if we skip down to the third benefit, it's tax-free. So if I'm earning, let's call it the middle 4% tax-free, and I'm in a 25, 30%, maybe I'm in the highest tax bracket over 40%, how much more valuable is a 4% tax-free internal rate of return or growth rate? Much more valuable. We're going to look at an example on that shortly. But the net performance, typically 3 to 5%. No risk, regardless of what's happening in the stock market, economy. If things are going very, very well in the stock market and economy, or if things are going very, very poorly. If we have a long duration of an economic downturn or stock market crash like 2008, the people felt that for a number of years. Whole life insurance products, guess what happened? Kept on increasing in cash value, continued to see that positive appreciation. A lot of people found a lot of value in whole life insurance products back then. In fact, a lot of additional awareness was brought to it at that point, the years 2008, really through 2012, afterwards as well. But I did see a lot of interest to the cash value benefit as I look at history. I got into this industry in 2011. But no risk. I don't have to worry about ups and downs. Liquidity. So you can access the money anytime you want. There's two ways you can actually access cash value in a life insurance policy. One, I can take a withdrawal, and two, I can take a policy loan. With withdrawals, that's just taking a withdrawal like I would from a bank account. I do need to be careful with that. If I'm doing it during the first 7 years, that can trigger a taxable event. We can provide more details on that, or I would search taxes on our YouTube channel to see what can trigger a taxable event on a whole life insurance policy. But loans are available anytime, with most companies available anytime. Some companies and some products will require that you wait at least 1 year before you can take a policy year, but as long as you have awareness up front and you're using a company that allows you to access a loan anytime, you can take a loan literally anytime you want. A couple additional notes to loans: payments are optional. I'm not required to repay it. I'm not required to pay the loan interest. It often does make sense to do so if I plan on using it, but often I hear the word loan, I think payments and interest. With life insurance policies, not quite the same. I'm not required to repay them like I would be required to repay a loan with a bank or a lender. No lost opportunity cost. This one is huge and attracts many people, particularly real estate investors, because they can resonate with what real estate does. For example, if you have a piece of property, let's assume it's appreciating at 5% every single year like clockwork, regardless of what happens in the real estate market, your property goes up by 5% every single year. Sound good? I like that property. Now, if you own that home free and clear, will you continue to earn that 5%? Of course. If you take a loan or line of credit against the property, let's assume that you access 50% of your equity, the 5% depreciation rate. Do you continue to earn that on the entire home value or just the remaining equity? The entire home value. There's no lost opportunity cost. Why I mention that is when it comes to a life insurance policy, particularly focusing on the cash value, it's the exact same thing. There's no lost opportunity cost. My money continues to compound. We're going to look at a specific model on that shortly. And then tax-free. Tax-free if I do things properly. So there are instances that can cause or trigger taxable events on a life insurance policy. I love to provide awareness on this feature because cash value life insurance is often marketed as a tax-free area to position money, period. And then we find out after the fact, wait a minute, I can't do this, otherwise I have to deal with taxes. I wish I would have known up front. So the first thing is what is called an MEC, which represents Modified Endowment Contract. If your policy becomes classified as a MEC, the cash value still grows tax deferred, but anything you want to access with respect to the gains only, you have to pay ordinary income tax on that. And if we're under the age of 59 and a half, we often have to pay a 10% penalty tax as well. The exception to that is if you're disabled. We don't want that. Easy to prevent. The other thing to be aware of is if you surrender the policy or if it lapses and there's a gain on the policy, the gains will be taxable as ordinary income. That's with a MEC policy or a non-MEC policy. How a policy can lapse if there's a gain on it is if I've loaned out the majority of my value. So if I paid in $100,000, I have $300,000 in cash value. I loaned out $290,000. So how much did you pay in? You paid in 100. How much did you loan? 290. So that's the 100 that you've paid in. You've taken that plus another 190. So you've got $190,000 more that you've taken from the policy than what you've paid into it. Let's assume the policy lapses. The gains will be taxable to you as ordinary income. None of this is tax advice. This is just how life insurance works, but I just want to mention none of this is tax advice. Point is, awareness on this is important. So let's hit on some of the material here. Let's start with the first point, the safety. Particularly here with the internal rate of return, question that often comes up is, hey, that 3 to 5%, like that's not bad, and I'm attracted to it with the liquidity piece in mind as well, where I can access that money, it keeps on growing. Perhaps I assign my cash value as collateral to a bank to get a line of credit at a lower cost to borrow. But it's like, I've noticed a lot of people in higher tax brackets, higher net worth, those considering or paying in 7 figures per year into policies, often look at that and it's a tough pill to swallow based on other assets and other asset classes that are available to them. So often what we like to look at, or what they'll look at before I even bring it up to them, or maybe one of their advisors will, is the taxable equivalent here. So the taxable equivalent is, if this is tax-free, what would I have to earn in a taxable account to earn 4%, to net a 4% return after it's all said and done? So how we look at that actually is, let's have some fun here. Here we go. So what we've got up here is a 40-year-old individual, and he's got a policy. In this particular example, it's a Mass Mutual 10-pay policy, $100K per year going into the policy for 10 years, total of $1 million. So safe area to position money. Where's the money going with the policy design? 10% premium, $10,000. We've got a term rider attached as well, which is less than $2,000 per year, and plowing everything else into PUAs. That's how, when we pay in $100K per year, we have almost 90% right off the bat in this particular example. Some companies and products will be closer to 82 to 83% if they have higher PUA fees. So typically see between 80 and 90% right off the bat. Year 2, he pays in $100K again. The cash value grows from $89,500 to $186 and change. That's less than the $100,000 that you paid into the policy. So if I earned 0, it would grow from 89 to 189. Remember that the first 2 years of a life insurance policy are the worst years of a life insurance policy. Next year, what do we see? Paying $100K, it grows by more than that $100K. It grows from 186 to 290. If I earned 0, it would grow to 286. I get another $4K on top of it. Next year, what's highlighted in yellow, my break-even point, when I have equal in cash value, an amount equal in cash value that's equal to my total payments. Paid in $400, I have $400. Continue to make payments. I can stop there, by the way, if I want to, or earlier, but we continue through age 50. That's what he wanted to do, and there's your cash value and death benefit. Then nothing is paid in thereafter. Cash value continues to appreciate. So this is a policy we mentioned with MassMutual that has a present dividend interest rate of 6%. The first year you pay in $100,000 and you've got what? $89,000 in cash value. You have a death benefit of almost $1.5 million, but if you are saying, I like the cash value, that's what I'm interested in, dividend of 6%, many people ask here, well, what did I earn on my cash value this year? The answer to the question is, you lost $10,500. So we may have a dividend interest rate of 6%, but it doesn't matter because my negative internal rate of return is almost negative 10 grand, a little bit more. So what we want to look at in this particular case is that internal rate of return. These are the questions you want to ask when you're looking at a life insurance illustration, or if you already have a policy and you're maneuvering through it, you're working with your agent, what questions should I be asking? This is exactly it right here. So what's the internal rate of return? There we go. So here, we've got two things, annual internal rate of return, and then also the average internal rate of return. The annual internal rate of return isolates what your cash value is growing by, or what it's not growing by in the early years, each year, annualized IRR. So an example that I like to use is if you've got your money in the S&P 500 and the market hit a home run last year, what did you earn? I earned 12%. Okay, great. That's what you earned annually, isolating that 1 year. What did you earn the past 30 years in the S&P 500? I averaged out 7 or 8%, Steve. That would be your average return. So when we look at the internal rates of return with the life insurance policy, the annual IRR isolates what you're growing by each year, annual IRR, and then the average takes the average over any time span that we're studying. So year 1, the annual and the average will be identical. Year 2, paid in $100,000. Remember where we got less back than what we paid in? If we were earning 0%, this was a 0% annual IRR, then we would see this cash value grow to $189,536. But it's a negative 1.78% IRR because we lost money in this particular example. Following year, what do you see? 100K goes in, you get more back than what you paid into it. The internal rate of return, 1.51%. However, the average is negative 1.6. The reason why is because you've paid in a total of $300,000, you have $290, so you're still $10,000 less than what you paid into the policy. That's where the negative 1.6% IRR comes into play over 3 years. Next year, finally positive. That's where I'm positive on the IRR, that is. And there I go. So you've got that 6% dividend. Does it ever hit 6%? No. Is it a safe area to position money though? Absolutely. Now, these internal rates of return assume that the company's dividend interest rate will remain constant forever, which will not happen. Dividends adjust over time. The 3 to 5% IRR we mentioned earlier is, in my opinion, when a policy is properly designed and positioned with one of the major mutual companies where we've seen historic proof of performance, that 3 to 5% is a great way to approach a policy if I'm interested in the cash value and set expectations properly. We've seen policies do better than that. If you've seen any of our historical videos or historical performance content, you've seen that as well, where some have done about 6%. Policy that was started in 1975 was at one point in time over a 7% IRR. But that's a long time ago. And those older policies lived through the late 80s and early 90s, which had what? Very, very high interest rates. So can we see that today? Higher internal rates of return, higher dividend rates? Maybe, but I'd much rather tell you 3 to 5% because that's realistic in my opinion, and then see it do better as opposed to telling you, hey, it's always done 4 to 6, so it can still do that. But then if it does 3 to 5, it's like, you kind of took that sizzle away, Steve. Set expectations properly. That's my main thing there. So those are our internal rates of return, isolating the cash value. We can run that on the death benefit as well. Why you see it drop here in year 10 to 11, goes from 3.3 to 2.2 to 2.25 million. That's an optional drop. We do not have to do that. The reason we did this here is once we are done funding the policy, we cut all insurance expenses. We have a term insurance rider attached to this policy. We dropped it at that point in time. The reason why is we're cutting the drag. If this individual, pretend this is you said, hey, 2.25 is enough. I'm mainly interested in the cash value and long-term death benefit. Let's minimize the death benefit to minimize any costs associated with this policy, which helps maximize the cash value growth. Doing that does result in a temporary death benefit drop. Why I say temporary is when you remove term riders, what that often does is actually enhance the long-term cash value or long-term death benefit, cash and death benefit. What would be beneficial to see here is what's it look like if we keep a term rider on the policy versus not keeping one on. That's a good case study for another video. My point is when we remove that drag, term riders, we reduce them. The death benefit will drop temporarily, but long-term you will see more insurance. If you've got more cash value long-term, that will result in more death benefit long-term as well. Because when I hit age 100, they become equal with each other. So great, safe area to position money. Hope you enjoyed this one. I had a ton of fun with it. We will get into the next one. Liquidity, we're going to focus on loans, and we'll have some fun. If you enjoyed this, please hit the like button, subscribe for more. Hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.